Okay, so in this chapter, we're talking about money. What exactly is it? We're going to learn about the functions of money, the characteristics of money. We'll learn how the money supply works. We'll learn about simple money market. So what are the three functions of money? So actually, can anyone list those out? From the pre-work, you should have come across those terms. So we're not talking about the characteristics, but what does money do in terms of its function? What's the big deal? Yep, so you guys got two of them. The first function of money is that it's a medium of exchange. It's an intermediary used in trade to avoid the inconveniences of a barter system. So a barter system is when you don't use money and everyone just trades physical objects. The problem with doing that is in order to be able to trade with someone, you need to find someone that wants what you have, and you have to want what they have. So you have to have this double coincidence of want. It's not only just double coincidence of wants, you have to think about the quantity. So if someone wants a toaster and you have a chair, if the person wants, or if you want two toasters for one chair and the other person only has one toaster, then you can't make an exchange, even though you both have, there's double coincidence of want. So you can imagine in a barter system, the amount of economic activity that would actually occur would be far less because of how inconvenient it would, and there would be a lot of, effort just to make trade. So we would have to waste a lot of our scarce resources like time and labor just to be able to find transactions that we place. So money is very important because it substantially reduces those inconveniences. And so its function as a medium of exchange is one of the most important. It also allows you to store purchasing power, right? You can save your money and spend it next year. Of course, inflation would erode this function. This function of money, is subject to inflation, right? So if you have hyperinflation, like we just talked about, it sort of erodes this function of money. But for the most part, generally, it allows you to store your purchasing power. And with bartering, you can do that, but you can't, right? It depends on, some goods are perishable, and if that's so say you live in a barter economy and you're a farmer or dairy farmer or something like that. Well, all of the stuff that you produce is perishable, so it's really hard to save any of it. I guess you would have to buy something else, maybe that you don't want, just to hold on to in order to trade it later. But with money, you don't have to worry about any of that stuff. You can put your money in the savings account, keep it under your mattress, and with low inflation, you have no worries. You can spend that in the future. Now, another important function is called the measure of value or unit of account. So you guys are accountants. Imagine doing accounting in a barter system. So how would you write down maybe just something simple like your net worth? So you can. It's very difficult. You could write down a list of objects that you own, but there's no way to value them. Their value would only be relative to other goods. So one chair could be equivalent to two pillows or whatever. It always has to be relative to something else. With money, everything's valued in dollars, and so we have a consistent unit of account. And so then with money, you can actually write down what the value of your goods and services are, write down the value of debt, etc., and also make calculations. So if you want to remember these three functions of money, just try and think about a barter system and what the issues are, and think about how money solves those, and these will easily come to mind. So now we're going to talk about something different. So don't confuse characteristics with functions. So characteristics of money are much different. So just to motivate it, let's ask a simple question. Why is a Canadian $10 bill or $20 bill that's printed by the Bank of Canada worth something in terms that, you can exchange it for goods and services, but a $20 bill from the Monopoly game is not worth it? So what's the main reason for that in general? Anyone? Well, the main reason is acceptability. So the money printed by the government that we use, it's not backed by anything. It has no intrinsic value. It's not like gold or silver, but we all generally accept it as a means of exchange, right? So we just know we can use it. We all generally accept it. And there is a bit of, the government has a law, so I guess that you can think of it as a law, that sort of helps that a bit, gives it a bit of more legitimacy. And what that is it's called legal tender. So it doesn't necessarily, it's not a necessity, it's not needed for an object to be generally accepted, but it just strengthens our acceptability. And all legal tender means is that if you are, you're a lender and you have someone you lent money to, so a debtor, that person who's in debt debt can legally give you Canadian dollars, satisfy that debt. That's all that means. So it only has value then in the sense that legally, if you're a lender and you want to bring someone to court for not paying their bill, their loan, then as a lender, you legally have to accept Canadian dollars as settlement for that debt. If it were to go to court and then the defendant said, okay, I'm going to pay the debt with Canadian dollars, and you're in Canada, then legally you can, that settles the debt. That's all this means. Now, it's important to realize too, so that this is only in situations where you have people who are debtors and lenders. When you go into a convenience store, you don't have a debt person, the owner, right? And so they don't legally need to accept Canadian money if they don't want to. Obviously they do, but they will usually not accept $100 bills because they're worried about them being counterfeit, and they're perfectly allowed to do that. Just because money is legal tender doesn't mean that everyone has to accept it. This is only in the situation of lenders and borrowers. So that's any object is not money unless it's generally accepted by everyone, right? So that's why this is the most important characteristic. Whatever object you use can be considered money as long as everyone generally accepts. But there's other important characteristics of objects that you want to use as money. It has to be something that's relatively scarce. So we wouldn't be able to use grains of sand as money, right? Because how is it ever going to have value? There's so much of it. We can't use paper money that can be easily printed on a computer printer, and it's indistinguishable because then it's not relative scarce. So that's, how money would derive its value. And, we want something durable, especially when we're thinking of the second function of money, which is to be able to store purchasing power. So, potato chips or anything perishable wouldn't be something that would serve well as an opt for money. Also, we would like something to be portable. So we don't want to be using, large objects like big rocks or stones. We want something portable. And so, money is, the money we use now is definitely portable. It has to be somehow divisible. So we want to be able to make change, right? That's the idea. So money should be capable of being divided into smaller units to enable it to purchase both high and low price commodities. In some cultures, people have experimented with animals. So animals, in traditional economies have been used as somewhat of a form of money, but, there's going to be certain transactions that won't be possible because you can't divide an animal, right? It wouldn't make it an animal anymore, right? So whatever object you use should be divisible. But again, the most important characteristic is acceptability. If it's not generally acceptable by everyone, then it's not money. This is just an interesting exhibit. I went to the Bank of Canada Museum before, and they had these on display. So there's been, some strange objects used as money. Just because of the time, I won't get into too much details, but back in the 1680s here, people used playing cards as money. And they're actually just waiting for a shipment of silver or something like that. So the soldiers weren't paid yet, but they used the cards as sort of a keeping track of the IOUs. So these things were sort of back to the silver. So when it arrived, you would exchange these cards for what you're owed. So that was the idea. So there's been some interesting objects that have been used as money. Okay, so now that we defined the function, the characteristics of money, let's examine the system in which it operates. So the supply of money is closely associated with institutions known as depository. So, like a bank. They accept funds provided by savers and lend these funds to borrowers and hold cash reserves to meet the needs of depositors withdrawing funds. So in the Canadian financial system, there's 4 traditional pillars: chartered banks, trust companies, insurance companies, and investment dealers. These are like stockbrokers. Financial deregulation at some point in the past, I think it was in the 90s, allowed institutions in each pillar to perform a wider range of functions. So while 80 chartered banks operate in Canada, there's really, the big 6 are RBC, TD, Canada Trust, Scotiabank, BMO, and CIBC, and the National Bank of Canada. These are the big ones. So, so there, at first it was mostly these big ones, and then, there's been a lot of new chartered banks the last few decades. So chartered banks are deposit takers. So you deposit cash there, and they're allowed by charter to offer a wide range of financial services. We don't need to get into this too much. I don't care, it's not that big of a deal for you to memorize these characteristics, but there are also trust companies, credit unions. These are, for all intents intents and purposes, they're all pretty, these two here, trust companies and credit, they're all, they pretty much function as a bank. There's not, that much difference. So I don't want you to memorize any of this stuff for testing purposes. RBC is probably the largest bank. I don't know if this changed since like 2013, but probably very little. So, these are the big eight. These are their relative sizes. So now let's talk about the money supply. So the total stock of money circulating in an economy is called the money supply. What constitutes the money supply? There are two main components. So currency, including notes and coinage. Okay, so the bills and change in your pocket, in everyone's pockets or under their mattress. And then there's demand deposits. Demand deposits are basically bookkeeping entries, right? So they're funds to which depositors have immediate access. And so these two things are the most liquid forms of money. The money that's in your checking account or in your pocket can be immediately used to purchase something, right? And so this is what we typically think of as the money supply. There are other components that are sometimes called near money, notice deposits or term deposits. So these are like savings accounts, but you need to give a few days notice before you're able to access the money. That's the main idea. So term deposits are maybe like a GIC or something where you put your money in and you can't touch it 6 months. Okay, so but generally the standard definition of the money supply, we're just including demand deposit and currency and circulation. You could also have foreign currency deposits, but the main money supply that we talk about would be the foreign. And there's actually some definitions. Sometimes these tend to differ in different textbooks and things, but just memorize the definitions that are indicated here. So here M1 plus includes currency outside of banks, publicly held demand deposits at chartered banks, and checkable notice deposits at chartered banks and near banks. This textbook's not the best for these. Usually this is just M1. Well, M1 should be just the definition that we talked about, which is just currency in circulation and demand deposits at any of the banks. This one's also including notice deposits and near banks, stuff like that. But anyways, M1 typically is, just think of it as the most liquid. It's just demand deposit and currency in circulation. M2 is M1, but it additionally adds notice deposits and personal term deposits. And then, M2 plus would include this, but then it adds corresponding, these types of deposits at near banks. And then M3, these are cumulative, right? So M3 additionally adds foreign currency deposits and then non-personal, so I guess business term deposits. And so in terms of liquidity, this is the most liquid. These include things that are less. Don't worry too much about this. I'm going to, skip over these, do these for homework. I want to make sure we finish lecture. Okay, so let's do these for homework. So some economists believe that M1 is the most accurate definition of the money supply. It's the one I like too. Some economists prefer M2 plus because of recent innovations in payment methods. The main point on this slide is that things like credit cards or debit cards or check, that isn't money, right? Those are sort of like instruments for transferring money, right? With a credit card, you're essentially transferring money from the credit card's bank account to the merchant bank account where you're buying something, right? A check is it's instructions for a transfer. What's underlying these are the demand deposit money, but the credit cards and debit cards and checks, stuff like that, in and of themselves are not money, okay? Their usage does not increase the money supply, okay? They're just sort of a means to doing some kind of a transfer. So we'll just now consider a simple model of the money market, and then we're going to need to learn this to understand some of the concepts for monetary policy. So the money market is the cornerstone of monetary policy, and again, we'll talk about that next chapter. There are four, important elements: the equilibrium price, equilibrium quantity, supply, and demand. So the supply of money, for simplicity's sake, we're just going to consider the M1 definition. So basically just currency in circulation and demand deposit. Okay, and for the demand for money, so why people would want to have their wealth in demand deposits or in money in their pocket relates to two different things: asset demand and transaction demand. And so the interaction of supply and demand determines the price of money, which is the interest rate. You can think of so when you hold money in your checking account or in your pocket, you're not getting any interest, right? I think you get a negligible amount in a checking account. It's not even worth bringing up. So there's an opportunity cost because you could have that in a GIC or some kind of a savings account with getting some interest anyway. I mean, the last 10 years we've been in the lowest interest rate environment that I know of in history. And so even in a savings account, it's kind of like you're not really getting that much, but there is a small interest rate, so there is somewhat of an opportunity cost. You can maybe think of also, you're not able, if you're holding on to your wealth in M1, your opportunity cost could be, investing in blue chip stocks, which pay a dividend and stuff like that. So anyways, there is an opportunity cost holding money, and that's the interest rate. That's what you're giving up. But you could also think of this maybe more generally as maybe dividends and things like that. But for the purposes of this model, we're keeping things simple. The opportunity cost we're going to say is just the interest rate. So we're going to think of a simple model, and in this simple model, people can either hold money, or we're going to say they can hold bonds which earn interest. And so for the money demand, there's two types. As I said, there's transaction demand. If we had all of our money in notice term deposits or something like that, or in the stock market, in things that aren't too liquid, then we're not going to be able to buy stuff quickly, right? So we like to have some money in our checking accounts or in cash so we can make daily transactions. Okay, so one of the key factors of demand for cash or demand deposits is transactions today. We need it to make purchases. And so if you think about the size of economy or the price level, there's going to be a relationship. If the larger the economy, the greater the GDP or national income, the more transaction demand for money there will be. So you can just think of the transaction demand maybe as being some proportion of overall GDP. The price level is also related to the transaction demand. If all else constant, prices were to double, you would need more money, right? And so there's a relationship there. The thing is, with transaction demand for money, it doesn't relate to the interest rate. Okay, so when we put this on our supply and demand diagram, it'll just be a vertical line because it doesn't depend on the interest rate, which is what is on our vertical axis. Now, asset demand is related to money's use as a store of purchasing power and is inversely related to the nominal interest rate. They should see if they go. Okay, so they don't really go into that too much detail here. So basically, we're saying we're basically going to say that the asset demand is a downward sloping line in the interest space and the amount of money space. We're just saying here that the higher the nominal interest rate, the lower will be the asset demand for money. Okay, so we have money demand, which represents the amount of money demanded for both transaction and asset demand purposes at all possible interest. So there's not much, when we did micro, we learned about a demand curve. A demand curve is just the quantity demanded at different prices, like a what-if concept. What if the price was this? What would the quantity demanded? It's the same thing here, except we're saying, what if the interest rate was this? What would the quantity demanded of money be? Okay, and so we'll have a downward sloping line. It will be comprised of both the transaction demand and asset demand for money. The reason why it's downward sloping is because of the asset demand for money. The transaction demand for money is like a constant. It's a fraction of whatever the size of the economy. Money supply, we're just going to say, is a set amount determined by government decision makers, and so it's just going to be a vertical line at the amount of money supply. So our money demand curve will look something like this. If we move along it, we're talking about different interest rates, how much the quantity demanded of money would be. If we shift it to the right or left, we're saying that at any of the interest rates, the quantity demanded is either increasing if it shifts to the right or decreasing if it shifts to the left. The supply of money, we're just going to say is fixed at a certain amount determined by the government. The government can do things to increase the money supply. We'll learn that in the next chapter. And if they do something like that, we represent it with a shift to the right or the left. So it's 251. So we'll just try and get to the end of this as much as we can. So as as in our micro chapters on supply and demand, the intersection of the two curves is the equilibrium, right? Any price not at the equilibrium. So the equilibrium interest rate here is 3%. So why would we end up going here? Well, because any hello? Someone is snoring. Wow, I didn't know that. It's an exciting topic, I thought. Okay, so at the equilibrium interest rate, everything's perfect. There's no shortage or surplus. At any other interest rate, you're going to either have a shortage or surplus and will lead you to move back to the equilibrium. Okay, that's the main idea. Now, I'll just finish up with this because it's very interesting. It gives you a good perspective on what banks are. So the first sort of form of banks were performed by goldsmiths. Goldsmiths would offer safekeeping stores, right? So people used to use gold as money, right? But, if you hold, if you have a lot of it in your home, especially back in medieval times in Europe, you could get robbed. It could be dangerous. So a goldsmith would give you safekeeping. You would go to the goldsmith, give the goldsmith your gold, and they would write you a receipt, an IOU. And it would say, pay whatever amount of gold to the bearer of this receipt on demand. But over time, people began to realize that they could just trade the receipts with one another. So for example, if you wanted to buy something off somebody, you would go to them, give them the gold, and then you would take the item. So you bought the item. So you're first going to go to the goldsmith, take out the gold, give it to the other person to buy the good, but then that person is just probably going to go back to the goldsmith and deposit that. So why not just trade the receipt? And so the receipts are basically promissory notes from the goldsmith. And so basically the first form of money would have been these promissory notes. And that's where the name note or banknote comes from. And so also the goldsmith, realizes that not everyone's going to come all at once to get their gold out of the bank. And so they could actually create money out of thin air. And they can do that just by writing more receipts. So there could be more receipts or IOUs in circulation than there is gold in the goldsmith safe. And that's fine as long as everyone doesn't come for their gold all at once. And actually it's a little more efficient too, and it provides income for the goldsmith. Because he's going to create receipts out of thin air, but he's not just going to distribute them. They're going to be in the form of loan. So the goldsmith could write a receipt to someone that wants to borrow money, and they would have to maybe pay a bit of interest. I guess they would have to give a little bit extra gold, and that's how the goldsmith would earn an income. And so that's the sort of the genesis of fractional reserve banking. So fractional reserve banking is where you have more receipts than what you actually have back, and that's exactly how the bank system works in modern times, except we're not talking about gold, we're just talking about the cash. So that's how money can be created out of thin air through lending. It's just, more receipts are created. So if you think of when you get a loan from the bank, the money just sort of does appear out of thin air. All of a sudden you get a credit in your debit account, right? And so that's essentially an increase in the money supply because demand deposits are part of the money supply.
So in this slide here, I have a nice summary for you for your study note that goes through the idea of how goldsmiths were originally bankers and how it's their IOUs that are similar to what we think today of banks. Now, an interesting historical note. So before the Bank of Canada was the sole issuer of currencies, you could actually go into a cafe, say for example in Montreal, and buy a drink with a Molson's banknote and get change in the form of a Bank of Montreal bill. And so as the article says here, it sounds like product placement gone wild, but it's actually the way things used to be in Canada until 1935 when the Bank of Canada became the sole legal issuer of Canadian currency. Until that day, many banks and corporations issued their own paper currency, all with their own designs and promising to redeem a certain amount of gold to the holder bill. And that's pretty much the way it was everywhere, even in other countries, until central banks started to realize it's a better system to have the government have control over the currency, and then they can implement proper monetary policy. Here are some examples of some original bills. So this is a Bank of Montreal note, and as you can see on here, it says we'll pay $4 to the bearer on demand. And so that was worth gold. This is a banknote from the Molson's Bank, and it says here chartered by Act of Parliament, and then it says we'll pay to to the bear on demand. We're going to switch over now to the money creation process. To do that, we just need to do some very simple accounts. If you look at a balance sheet, you have on the left, you have assets, okay? So this is assets, and we're just going to consider reserves. So these will be cash reserves of the bank, and then loans and bonds, which are assets. If you own a loan, it's an asset to you. And on the right, you have your liabilities. So we're just thinking here of deposit liabilities. So when someone deposits money at a bank, the bank now has a liability. And so the difference between your assets and your liabilities is the net worth of the enterprise. And so that's what we call the owner's equity. So the reserves are cash in the vault and deposits at the central bank. And deposit liabilities could be in the form of checking accounts, savings accounts, term deposits, and they could be from regular citizens or businesses, corporations, or the government. What is a bond? Basically an IOU from a company that has borrowed money from an investor. When a bank buys a bond, it is lending money to the issuer of that. Okay, so the money creation process. So first we need to define some terms. First, let's define what desired reserves are. Desired reserves are the minimum cash reserves that deposit takers hold to satisfy anticipated withdrawal demands, right? That's like the goldsmith. The goldsmith would hold on to only a certain portion of the gold, or they would have the amount of receipts in circulation at a much less or lower fraction, or a much higher fraction than what they actually have gold. Similar sort of thing with the modern banking system, except we're just thinking of cash, not gold. And so if someone comes in and deposits a $1,000 bill to a bank, they don't need to hold on to that entire amount. They can lend some of it out. And so how much they would want to have in reserves is, when, that's what we're thinking about in desired reserves. So this term here is the minimum cash reserves that deposit takers hold to satisfy anticipated demands or withdrawals. Now, what's more useful, or equally as useful, is the desired reserve ratio. So now this is stated as a proportion or percent, right? And it equals the required reserves divided by deposits. Okay, so here then you have a certain portion of deposits that the bank desires to keep in reserve. So it could be something like 10%. And so that means it's only going to hold on to 10% of any deposits and lend out the rest. Now, we can use this ratio then to figure out if a bank is over or under reserve. Because if we know that their desired reserve ratio is 10%, for example, then we can multiply that by the amount of deposits they have, and then we would get what their reserves should be based on that ratio. And so if their actual reserves are higher, then they're over reserved. If their actual reserves are less, then they're under reserved. So at times, deposit takers find that their cash reserves exceed desired levels, or they have excess reserves, as I said. And so that's simply when the cash reserves are less than the desired reserve. Okay, so, or the actual reserves they have are greater than what they desire. So for example, a chartered bank with deposits of 100 million with desired reserves of 10 million may find itself holding 14 million in actual reserves. So since 14 is greater than 10, we would say they have excess reserves, and in the amount of a million. So because idle cash reserves earn no profit, deposit takers will try to transform any excess reserve into income producing assets as quickly as possible. So they have a strong incentive not to have cash sitting around because it's not earning any. So they will tend to want to loan it out or invest it. We'll focus just on the loaning out. And so in our example, here, this bank would be, have a strong incentive to lend this $4 million out. Otherwise, it's just sitting there not earning any return.